Hello, and thank you for watching this International Financial Reporting for Non-Profit Organisations webcast on fundraising costs. This webcast is part of a series that covers some of the key issues in financial reporting that affect non-profit organisations and that are included in the IFR for NPO consultation paper. This session begins by looking at why fundraising costs are an important issue for NPOs. Next, we will consider the main financial reporting considerations that NPOs face with fundraising costs. We will then look at how these issues are currently addressed in the existing accounting standards, beginning with the international frameworks, before looking at how some national standard setters have addressed NPO-specific issues. Finally, we will look at the alternative treatments identified in the IFR for NPO consultation paper and how you can share your voice and respond to the questions raised. Information about fundraising costs is important to many users of NPO financial statements. Users may compare fundraising costs with the income generated or with program delivery costs, and use this information to assess efficiency. But ratios of fundraising costs to income or other costs may, however, be misleading. This is because fundraising activities and therefore costs are not easy to define. Some fundraising activities may seem relatively obvious, such as a fundraising event. But other activities are also important to income generation, such as writing grant proposals or maintaining a website. These may be less easily identified as fundraising. And activities with the primary objective of raising funds may also serve additional purposes. A fundraising event may also be used to share a mission-related awareness message. Even if it fails to generate net income, such an event may still be considered worthwhile if other objectives of the NPO are met. There are a number of financial reporting considerations related to fundraising costs. The way direct costs are allocated to fundraising can be subjective. The method used to allocate direct costs, such as staff time or the running costs of a shared vehicle, to different projects or activities, can vary widely from one organisation to the next. This may lead to a lack of comparability amongst similar NPOs. The true cost of fundraising activities may also include an element of indirect costs, and again, the methods used to allocate these can vary widely between organisations. NPOs may have incentives to maximise the allocation of overheads to service delivery activities, rather than management or fundraising, and the costs and complexities of allocating indirect costs between fundraising and other activities may outweigh the benefits. In addition to issues with respect to the allocation of costs, fundraising costs are generally incurred before the corresponding income is generated. This timing difference can mean that the costs and income recognised in any given accounting period may not be comparable, and the identification of costs of fundraising activities may not align completely with cost classification by function, such as administration or distribution, or natural classification categories, such as labour or materials. This can mean they are not readily identified from an NPO's accounting system, and accounting systems may lack the functionality for assigning specific costs to both an account for classification by nature and an additional element to denote activity. These financial reporting considerations mean that there may be benefits to NPOs and users in standardizing the definition of fundraising costs. This would involve addressing the presentation of direct funding costs, the treatment of business development costs, the basis of allocation of overheads, and disclosure requirements. For example, guidance could ensure that fundraising costs are recognised using the same principles as any other expenditure and are presented gross in accordance with the known netting off principle, and additional disclosures could be considered to assist users understand fundraising activities, with standardized information about fundraising costs and information about timing differences. The usefulness of ratios could also be considered further alongside a framework for narrative reporting. Having established that there may be benefits to MPOs and users in standardizing the definition of fundraising costs, we can now examine what guidance is provided in existing accounting standards, beginning with the international frameworks. The international standards do not specifically address the financial reporting issues we have identified with fundraising costs. With respect to the presentation of expenses by nature or function, IAS 1 presentation of financial statements and IPSAS 1 presentation of financial statements both require an entity to present an analysis of expenses classified either by nature or function within the entity. They require an entity to choose whichever provides information that is reliable and more relevant. Function is not, however, defined in either standard. The information may be presented either on the face of the statement of financial performance or in the notes. The IFRS for SME standard also requires an entity to present an analysis of expenses, classified either by nature of expenses or function. Full IFRS standards and IPSAS, but not IFRS for SMEs, also provide further guidance on segmental reporting that could be relevant to fundraising costs. IFRS 8 operating segments and IPSAS 18 segment reporting focus on the disclosure of operating segments of an entity and on the services and geographical areas in which an entity operates. The standards are intended to provide users with more information on performance and assets and liabilities. IFRS 8 focuses on the revenues of an entity, and identification of segments is based on internal reports that are regularly reviewed by the entity's chief operating decision maker. IPSAS 18 is similar, but the decision-making requirements for segmental information are more focused on resources allocated to major activities. This is designed to enhance transparency, to enable an entity to discharge its accountability decisions, and may provide a more useful reporting structure for NPOs. The application of segmental reporting to fundraising costs may, however, require other parts of the business to be reported in the same way, and would require disclosures on performance, assets, and liabilities for each segment. This could be burdensome. Looking now at national level guidance, while there is no one single view of the definition of the cost of fundraising, a few jurisdictions have developed additional guidance on different aspects of the reporting of fundraising costs. One jurisdiction requires all expenditure on fundraising to be identified and provides a list of activities as examples, such as seeking grants and donations, operating membership schemes, staging events, and operating charity shops selling donated goods. It also requires that costs and income are shown gross. Another jurisdiction has developed guidance for smaller entities that provides for an analysis of expenses that draws on expenses by nature and function. Expenses for public fundraising are required to be disclosed as part of this guidance. A third jurisdiction provides guidance on allocating costs of fundraising from certain joint activities. Typically, advertising and other business development costs are not included in fundraising costs, but would be included in other functional activities, such as management and general activities. It requires the cost of fundraising to be presented on a gross basis, except for some costs associated with special events, such as fundraising galas. The guidance also includes what it describes as a programmatic element. And a final jurisdiction has guidance that addresses the timing of the recognition of fundraising costs. The consultation paper puts forward 3 alternative options for fundraising costs. Alternative 1 allows organisations to use any of the international frameworks as they have similar requirements for analysing expenses by nature or function and require them to be presented on a gross basis. This would allow NPOs to continue to develop their own policies on the treatment of such costs, with additional guidance provided to support NPOs with the identification of fundraising costs and recommendations for financial reporting. This might include fundraising costs being reported as a function as part of a functional analysis. Alternative 2 requires an entity to follow one of the international frameworks with additional guidance that requires, where fundraising costs are included in the financial statements, an NPO to disclose its accounting policy for fundraising costs. This would include which types of costs form part of this activity and the approach to the allocation of overhead. Alternative 3 would rely on new NPO-specific guidance being developed. This would require fundraising costs to be disclosed along with the accounting policy. The guidance developed for this alternative could provide the basis for a standard definition along with cost allocation methodologies and might usefully include a list of fundraising activities to assist NPOs. As highlighted, full IFRS standards and IPSAS include segmental reporting requirements in their analysis of expenses. Segmental reporting has not been included in the alternatives, as it may be too onerous for smaller organisations. And, consistent with the international frameworks, none of the alternative approaches permit costs to be netted from the related income. Pragmatically, it is recognised, however, that there may be a limited number of examples where exemptions from this might be permitted. This is your opportunity to shape the future by sharing your voice. Amongst a range of issues covered in the consultation paper, we want your views on fundraising costs, including how fundraising costs have been described, the alternative options that have been put forward, and whether fundraising costs should be reported gross or net. Please respond to the consultation paper. The consultation period ends on the 24th of September 2021. Shape the future, share your voice, submit your response.